So the Fed is lowering rates, but mortgage rates have gone up. A lot of people don't understand why and what's going on. So we wanted to break that down. First, the Fed raised interest rates to try to combat inflation, because raising interest rates slows down the flow of money because it increased the cost of money. That means people borrow less, and debt is money. It's actually one of the main ways that the Fed inserts money into the economy. By lowering the cost, more people borrow, and that borrowing creates more spending, and the economy grows. When the economy grows, we have inflation, or the rising in price in goods. Now, inflation sounds like a scary word because when it's high, it is scary. In fact, it can destroy an economy, like we have seen in many economies. But normal inflation at 2 to 3% is actually a good thing. In fact, it's necessary. We want things to go up in price, like our salary. We also want things like the cost of debt to go down, or the impact of that debt to go down in relative terms to the cost of goods and services. The Fed lowered interest rates to put money into the economy because of COVID. They were worried that the economy would shut down, and this worked really well. The economy blew up. That lowered the value of money and made everybody want to invest and spend their money. That's what they do. The problem was it was completely overboard, and it sent inflation through the roof. When the money supply gets so big that there's more money chasing goods and services than there is goods and services, the price of those goods and services skyrocket. This is bad. Nobody likes it when their eggs or bread goes up 30% because they're not getting a 30% increase in their salary. So the Fed needs to slow that down by doing the opposite of what they did during COVID. Raise the cost of money through debt, and that will slow the economy down. Not as much debt goes out, people stop spending as much, and then there's less demand for those goods and services. So the rate of inflation goes down, meaning the prices don't necessarily go down, that's deflation. But the rate at which they go up, that does slow down. And they achieved that. They got it down to just under 3% inflation rate, or that growth rate. So they came out and said, hey, we think we can start to lower the cost of money through interest rates, and the Federal Reserve is going to lower interest rates because then they start to get worried about the economy slowing down too much. A Goldilocks event. They want it to be just right. They don't want there to be too much inflation, but they definitely don't want deflation. That causes depressions. When prices of assets and goods and services tank. That's like when your house was worth $200,000, but then it's only worth $100,000. Not good. So they lowered interest rates and everyone cheered. That means debt's going to get cheaper and we're all going to be able to buy more. But that didn't happen. Instead, the 30-year mortgage went up. Right now, financing for real estate is really hard, even for self-storage. The markets are very challenging. Live Oak Bank is a specialist in financing for self-storage, including SBA loans. They are one of the leaders in financing all sorts of deals and deal size. We trust Live Oak Bank for their specialty in self-storage, their unique approach, and how they help their customers go through the process so there's no surprises. That in itself is a testament to their exceptional service and support. So whether you're looking to acquire, build, or expand a storage facility, Live Oak Bank has to be number one on your list to call. Click the link below right now so you can experience the difference that a dedicated self-storage partner can really make. First of all, there's a big turning point in October. We already know the Fed lowered interest rates and they're going to continue, but the 30-year mortgage started to go up. It's because of how we get our 30-year mortgages. You see, in order to get the debt into the market, we have to sell bonds. Now, these are sold from the Treasury, and we have a 30-year Treasury. Now, if an investor buys a 30-year treasury, they are going to get a 4.6% return. When everyone's worried, in order to get this debt, you have buyers and you have the government selling. Now, this is the key. Debt is a marketplace. And when everyone is really worried about the economy, they rush to find safe assets that will pay them a return. That way, their money isn't worth less because of inflation. People run and they buy things like the 30-year treasury. Now, when you have more demand, you actually have to pay them less. So, rates go down because you have more buyers than you have treasury bonds. So, you don't have to pay as much because everybody wants them. It's the opposite, though, if everyone thinks that the economy is going to boom. So, if you're an investor and you're going to buy a treasury that pays you 4%, that's because you think that this is safe, and all the other assets like stocks, bonds, your real estate, all of that, everything else won't perform as well. So you're going to buy this because it's the safest, best option for this return. But if I think that the stock market's going to go up, and if I think that we're going to have rise and increase in inflation, and businesses are going to grow and the economy is going to do good, I'm going to sell these and I'm going to buy other assets. Essentially, we have to pay investors more, so they buy the asset. And this is what's happening. You see, right here in September, once we had a new administration, we saw a change in the flow of money, meaning people expected things like inflation and a pro-business environment, deregulation. So the money started to move into assets that would benefit from that, meaning we expect growth. That's what investors were saying. And they started to buy assets that would produce a good return in that environment. And they also thought that these won't do as good. So they left them. And that's why we had interest rates start to rise. Because it is affected by supply and demand, it is a normal marketplace. Now, normally we see this in the short term as money adjusts. And then over time, as the Fed keeps lowering interest rates, we generally will see these follow. The Treasury yields will be represented as people are buying and selling, but they are not a direct reflection of the Fed and lowering interest rates, because this happens in a marketplace. But your 30-year mortgage can actually go up. So are they going to stay high? Are they going to go higher? Well, the truth is we don't really know. But generally speaking, this is most likely an after-election bump. We saw this with all sorts of assets. Remember, as yields went up, this means investors were not wanting to buy. But guess what they did want to buy? Stock market. And the stock market went up. In fact, it roared. This too is generally a reaction to the shift of mass money in the economy. Normally, like we've seen in the last few days, the stock market starts to cool off and it starts to come back down. Now, it did not go back down, but it still gave off some of those gains and cooled down a little. This is generally what we see and would expect to see, that this is probably a high in a trend. And as things adjust, we will see 30-year mortgages lower, especially because when we have change, we have uncertainty. So investors are celebrating a pro-business environment and buying up stocks and other assets. But they're always going to get scared about something. And there's a lot of change going on in the world, which means we will have events and things that happen that make investors want to flee back to safety. As this happens, we will find an equilibrium in the marketplace. But in the short term, it can seem to be a little volatile, especially when there is large political change and investors are digesting all of that information to try to understand where to put their money for the future.